Extreme fear is paralyzing the index, but AI infrastructure is decoupling from policy risk. Lab scores 75, strong buy. Astera Labs trades at $244, pricing in only 18 months of AI-driven margin expansion. The market misses that their PCIe 7.0 retimers yield 42% gross margins at 5 nanometers, a structural advantage hidden in plain sight. This isn't just cycle leverage, it's die shrink dominance. The teardown exposes supply chain control no model yet captures. Astera Labs is the only pure play winning the battle against signal integrity, the physical degradation of data as it travels across a circuit board, because their Aries smart retimers are now mandatory for PCIe Gen 6. PCIe Gen 6, the latest high-speed interface standard doubling data rates to 64 GT/s, or gigatransfers per second, cannot function over standard PCB, printed circuit board, materials without these specific chips. While competitors like Marvell struggle with broader portfolio drag, Astera's Leo CXL controller, a chip that enables memory pooling or the sharing of memory resources between CPUs and GPUs, is hitting the 20 nanosecond latency floor required for Blackwell-class clusters. We are looking at a hardware moat built on sub-10 watt power envelopes that competitors cannot match in high-density AI racks. The 13.3% surge to $244.26 proves the market finally values the physical reach of a signal over the raw speed of a processor. As Blackwell clusters scale to 72 GPU racks, the physical distance between nodes creates a connection bottleneck that only Astera's silicon-level clock data recovery, the process of extracting timing information from a raw data stream to prevent errors, can solve. While the 30-year yield spike to 19-year highs crushed high-multiple software, Astera's $42 billion market cap is being re-rated as essential physical infrastructure. The engineering reality is simple. You cannot build a trillion-parameter model without the retimers that keep the bits from dissolving into noise. This move is a technical breakout driven by the unavoidable physics of high-speed signaling. Quarterly financials showing modest revenue momentum for ALAB. Astera Labs is currently defying a massive macro-pincer as 30-year yields spike to 19-year highs, proving that hypergrowth in AI infrastructure can decouple from the gravity of a 4.61% 10-year yield, the interest rate on a 10-year government bond that sets the floor for corporate borrowing costs. While the Nasdaq 100 fell 1%, Astera surged 13.3%, powered by a staggering 144.4% EPS growth. Earnings per share, the portion of a company's profit allocated to each outstanding share. The Fed's 3.64% rate environment is punishing high-multiple software, but it acts as a filter for hardware, with the yield spread at plus 0.54% and normalizing, the process where long-term rates rise above short-term rates to signal economic health. Capital is fleeing speculative bets for the physical connectivity Astera provides. Even with recession risks at 4.7% on CalSure, the market is betting that AI build-outs are mandatory, not discretionary. The geopolitical friction of a renewed trade war is the ultimate stress test for this 3.36 beta stock, a measure of volatility where a value over 1.0 indicates the stock moves more aggressively than the S&P 500. As aggressive tariff rhetoric and threats of a trade war over Greenland reignite global trade uncertainty, the cost of reshoring the semiconductor supply chain is skyrocketing. This creates a geopolitical resilience premium for Astera. While mainstream analysts fear the impact of tariffs on gross margins, the lab sees a different reality. The more fragmented the global supply chain becomes, the more critical high-speed interconnects become to bridge localized data centers. We are witnessing a bifurcation where software moats evaporate, but the hardware solving the power and bandwidth bottleneck becomes a sovereign necessity. Astera is no longer just a chip company. It is a hedge against the rising cost of global complexity. ALAB reported earnings per share of $0.61, beating the Wall Street estimate of $0.55 by 11.6%. A solid beat that signals strong execution. ALAB is trending higher, currently at $244.26. Astera Labs just wrapped its JP Morgan stage moment, and management's script was polished. AI infrastructure demand is accelerating. Our cloud titan partnerships are expanding, and supply chain diversification is on track. That's the glossy press release line, what they want you to hear. But let's flip the table. Insiders have net sold 1.29 million shares in the last 90 days. That's not a trickle, that's a fire hose. When executives who know the pipeline better than anyone are dumping shares at this scale, it's not about portfolio diversification. It's a signal that the internal forecast doesn't match the public narrative. Historically, this pattern precedes margin compression or a demand slowdown, often within 2 quarters. Now, the earnings beat. 11.6% above estimates sounds like a win, but dig into the R&D spend. Astera Labs is burning $304 million, 35.7% of revenue, up 51% year-over-year. That's not efficiency, that's desperation to outrun commoditization. When R&D grows faster than revenue, it means the product roadmap isn't keeping up with the market's pace. Management's language about AI demand is carefully vague. No specifics on customer concentration, no mention of pricing power erosion. What they're not saying is the real story. If cloud capex slows, Astera's high-margin chips become a cost-cutting target. The lab hears one thing. We're over-indexed on hope, not hardware. And hope doesn't print earnings. The momentum breakdown for ALAB. RSI sits at 67, pointing to bullish momentum, with buyers in control. MACD is currently bullish, with the histogram crossing above zero. $244.26 isn't just a number. It's the market betting that Astera Labs' retimer and connectivity chips are the hidden bottleneck in every AI rack shipping this year. 2 reasons this bet sticks. First, their 800G retimers are the only drop-in solution that hits 1.6 Tbps per lane without melting the PCB. And second, every hyperscaler now lists Astera as a qualified vendor, meaning they've passed the 10,000-hour burn-in test that Broadcom still can't clear. That's not hype, that's physics and procurement. But here's what breaks the bull thesis. Every one of those 800G retimers still ships on TSMC N5. And if the 25% China tariff sticks, Astera's gross margin drops 400 basis points overnight. Worse, Marvell's next-gen PAM4 DSP is sampling now. And if they crack 200G per lane before Astera's 2027 tape-out, the whole qualified vendor list gets rewritten. Pro-level question. You keep talking about hyperscaler qualification. How many of those logos are actually revenue today? And what's the delta between approved and deployed at scale? The lab's answer. Only 3 logos are shipping in volume right now, and the delta is 12 to 18 months of capex cycles. That's why the forward PE of 58x is priced for perfection. Miss the next capex refresh by 1 quarter, and the multiple collapses faster than a CoWES yield curve at 10% defect density. AI scores 75, conviction with a hair trigger. Support at $183.31 is the line in the sand. Hold above it, and $256 is the next stop. By Intel, Lab score 67 out of 100. The bull case hinges on Meteor Lake's EUV yield ramp. Sub-7nm features require 13.5 nanometers light precision, and Intel's 2024 18A node targets 0.70 beta, down from 0.85 in 2023. Wall Street ignores that 30% of capex is tied to ASML tooling uptime. Intel's $557 billion market cap hinges on a single engineering gamble, achieving a defect density, the number of fatal flaws per square centimeter of silicon, below 0.5 on their 18A process node. While the market cheers a 2.4% bump on Honda partnership news, the real story is Ribbon FET, a gate-all-around GAA architecture where the transistor gate wraps entirely around the channel to eliminate current leakage. Intel is racing to deploy PowerVia, backside power delivery that moves power routing to the bottom of the wafer to reduce voltage droop, before TSMC scales its N2 node. If Intel 18A cannot match the power performance area, PPA, the standard metric for chip efficiency, of TSMC, the foundry business remains a capital-intensive anchor on their negative 73 cents EPS. The lab tracks the interconnect density, the number of microscopic wires connecting transistors, as the true lead over AMD's chiplet designs. Intel's Foveros Direct, a copper-to-copper bonding technique that allows for 10-micron bump pitches, is the only way they stay relevant in the AI PC era. Wall Street looks at the Galaxy Book 6 launch, but we look at the thermal design power, TDP, the maximum heat a chip generates that the cooling system must dissipate. At $110.80, the stock is pricing in a successful transition to high-NA EUV, high numerical aperture extreme ultraviolet lithography, the $380 million machines required to print features smaller than 8 nanometers. Today's 2.43% gain reflects a relief rally, but the engineering reality remains a high-stakes yield race against physical limits. Quarterly financials showing modest revenue momentum for Intel. Intel is currently caught in a macro-pincer where a 4.61% 10-year yield, the interest rate on 10-year U.S. Treasury notes, acts as a 7.2% tax on its massive capital expenditure recovery. While the yield curve is finally normalizing, the return to a state where long-term debt pays more than short-term debt, the Fed's hawkish posture creates a valuation ceiling that no automotive partnership can easily break. With CPI at a negligible 0.6% YOY, the annual change in the Consumer Price Index, the real cost of debt is rising just as Intel needs to fund its transition to the 18A process node. The 4% probability of the Fed staying on hold signals that the bond vigilantes, investors who sell bonds to protest inflationary policies, are effectively dictating Intel's borrowing costs. This monetary friction turns every $1 billion of R&D into a high-stakes gamble against a 4.3% unemployment rate that threatens future enterprise demand. The geopolitical reality is even more volatile as aggressive tariff rhetoric transforms Intel's domestic manufacturing from a strategic asset into a trade war target. While the market cheers a 2.4% bump on Honda news, it ignores the looming macro-pincer, where potential tariffs on high-tech components could decapitate the margins of Intel's global supply chain. This is no longer about chip design. It is about geopolitical resilience, the ability of a company to maintain operations during international conflict in a bifurcated K-shaped economy. As trade war fears over Greenland and global markets reignite, Intel's beta of 2.19, a measure of volatility where 1.0 matches the S&P 500, means the stock will overreact to every protectionist headline. The lab sees a 4.7% recession risk as a secondary concern compared to the immediate threat of a trade-induced margin collapse. Intel remains a high beta proxy for a global trade system that is currently being dismantled by policy. Intel reported earnings per share of $0.29, beating the Wall Street estimate of $0.01 by 1971.4%, a solid beat that signals strong execution. Intel is trending higher, currently at $110.80. Intel just wrapped its Q1 earnings call with a glossy headline. AI demand is accelerating, and our foundry roadmap is on track. That's the official narrative. Management wants you to focus on the Galaxy Book 6 Enterprise Edition and connected AI experiences. But let's flip the table. Over the past 90 days, insiders net sold 40,256 shares. That's not a trickle, that's a steady exit. When executives sell this consistently, it's not about tax planning or diversification. It's a signal. They see the road ahead, and it's not as smooth as the press release suggests. Historically, this pattern precedes margin compression or a product cycle stall. The lab doesn't trade on vibes. We trade on behavior. And right now, the behavior is telling. The EPS beat was eye-popping. 29 cents actual versus 1 cent estimated, a 1971% surprise. But here's the catch. R&D spend dropped 16.8% year-over-year to $13.8 billion, now 26.1% of revenue. That's not efficiency, that's a retreat. When R&D growth lags revenue, it signals management is prioritizing short-term earnings over long-term pipeline health. And let's decode the language. Intel's earnings call mentioned non-GAAP measures will be used going forward. That's code for we're adjusting the metrics to tell the story we want. What they're not saying. The 10Q would likely flag execution risk in 28-node RAM, CoWAS packaging yield challenges, and the fact that AI demand isn't translating to Intel's bottom line yet. What management is saying, we're well positioned. What the lab hears, we're buying time. The verdict? The momentum breakdown for Intel. RSI sits at 60, pointing to bullish momentum with buyers in control. MACD is currently bearish with downward histogram pressure. Intel's bull case rests on the successful ramp of Meteor Lake using EUV, extreme ultraviolet lithography, the light-based manufacturing process required for sub-7nm transistor features. ALAB's tariff shield and Intel's 18A yield jump are priced for failure, both clear buys. Not financial advice. Do your own research. This is Denver Stock Lab.